Imagine a missile hits a building 5,000 miles away. 3 days later, oil traders panic, ships reroute, insurers raise prices, and your next grocery bill starts moving in the wrong direction. A mortgage quote gets worse. A company delays hiring. A government quietly prepares to borrow more. That is the part most people miss about World War III. Your money does not need a missile to reach your street. This is not a prediction that World War III will happen. It is a financial stress test of what could happen to your money if a global war spread. No stock tips. No political cheerleading. Just one question. If a global war spread, what would actually happen to your money? Subscribe to Money Explained. Money Simplified. War does not only destroy buildings. War reprices the things you use to live. Fuel, food, mortgages, taxes, jobs, pensions, insurance. Even if the war never reaches your street, the bill can. The IMF's April 2026 World Economic Outlook is called Global Economy in the Shadow of War. Under a limited conflict assumption, the IMF projects global growth at 3.1% in 2026 and 3.2% in 2027. Global headline inflation is expected to rise to 4.4% in 2026. Then the IMF expects it to fall to 3.7% in 2027. That is already a warning light, not because the IMF is predicting World War III, but because even limited conflict can push commodity prices, inflation expectations, and financial conditions in the wrong direction. This is not a video about who wins a war. This is a video about who pays for the shock. And the answer is uncomfortable. The payer is not always the country on the map. Sometimes it is the person renewing a mortgage. Sometimes it is the family buying groceries. Sometimes it is the worker whose company delays hiring because credit became too expensive. To understand why, start with World War II, not the battlefield. The balance sheet. The IMF says countries spent more on World War II than on all previous wars combined. By 1945, many economies were left with inflation, debt, trade deficits, balance of payments deficits, and depleted gold and dollar supplies. That is the first lesson. Wars can end militarily before they end financially. Shortly after World War II, UK government debt peaked near 270% of GDP. Put that in household language. That is like a household earning $80,000 carrying about $216,000 of debt. The UK debt ratio then took roughly 3 decades to fall toward 50% of GDP. Not 3 months. Not one budget. Roughly 3 decades. The images change from ration books to banking apps, from 1940s breadlines to digital bond markets. But the money logic rhymes. War spending becomes borrowing. Borrowing becomes inflation pressure. Shortages disrupt trade. Trade disruption creates currency stress. Currency stress makes imports harder. And debt lasts longer than the fighting. That is why the financial lesson of World War II is not just war is expensive. Everyone knows that. The real lesson is sharper. The war bill can stay inside the economy long after the war leaves the front page. Now bring that into today's world. A modern global war would begin with a repricing of risk. Energy, shipping, credit, inflation, defense, profits, currencies, and household bills would all be repriced at once. That is why World War III would not only be a military event, it would be a global repricing event. First channel, energy. Reuters has reported that the Strait of Hormuz is a choke point for about 20% of global oil and liquefied natural gas shipments, one narrow waterway, about 1/5 of global oil and LNG flows. That is the kind of number that turns geography into a household bill. On June 1, 2026, Reuters syndicated market reporting showed US crude futures around $89.65 a barrel, and Brent futures around $93.17 as of 04:36 GMT, after the US and Iran traded strikes and concerns rose around regional supply risk. That exact number can move during the day. But the mechanism is the point. When oil jumps, it does not stay inside oil markets. It becomes petrol, diesel, heating, electricity, flights, packaging, plastic, freight, and food transport. The barrel is not sitting in your kitchen, but its price is hiding inside the truck that brought food to your supermarket. Here is the twist. Energy inflation does not stay inside energy. It leaks into fertilizer, shipping, aviation, factories, and government budgets. What if the war never comes near your country, but the fuel bill for moving wheat, medicine, and machine parts keeps rising? Would that still feel like a distant war? Second channel, food. Food prices are not just about farms. They are about diesel, fertilizer, shipping lanes, insurance, storage, and currencies. FAO said the World Food Price Index averaged 128.5 points in March 2026, up 2.4% from February 2026 and 1% higher than March 2025. That is not just a food statistic, that is pressure entering ordinary life. In the same March 2026 update, FAO said world wheat prices rose 4.3%. But the reason matters. FAO linked that wheat increase mainly to drought-related deterioration of crop prospects in the United States and expectations of reduced plantings in Australia because of higher fertilizer costs. That is exactly how the money system works. The food may still exist, but if fertilizer, fuel, weather, shipping, and insurance all become more expensive, the final price cannot stay isolated. After Russia's full-scale invasion of Ukraine in February 2022, the Black Sea Grain Initiative later allowed nearly 33 million metric tons of grain and other foodstuffs to leave Ukrainian ports. Nearly 33 million metric tons. That is not a small shipment. That is a floating food lifeline. And it shows why a blocked port does not stay a port problem. It becomes a grocery problem. The visible war is fought with weapons. The invisible war is fought with invoices. And invoices move faster than battlefield maps. Third channel, shipping and insurance. If you are sitting there thinking, I do not own a shipping company, remember this. A huge share of the goods around you crossed the sea before they reached a shelf, a warehouse, a factory, or your front door. Shipping is not just a ship moving across water. Shipping is distance, fuel, crew, port fees, insurance, financing, and risk. When war risk rises, the ocean becomes a toll road, and someone eventually pays the toll. Reuters reported that during the Red Sea crisis in September 2024, additional war risk premiums were quoted as high as 2% of vessel value for a single transit, up from 0.7% earlier that month. For a $100 million ship, 2% is $2 million for one risky passage. That is just insurance. One ship, one transit. Now think about how many goods move through global shipping. Electronics, clothes, food ingredients, medicines, machine parts, car components, furniture. When the ship pays more, the cargo pays more. When the cargo pays more, the importer pays more. When the importer pays more, the shop pays more. And eventually, the customer wonders why everything feels slightly more expensive. There was also reporting in April 2026 that Iran might try to charge fees or tolls to ships passing through the Strait of Hormuz. Reuters reported that media reports suggested Iran might want to charge a toll, and Western leaders pushed back against the idea. So the safe way to understand this is not, every ship definitely paid $2 million. The safe money lesson is this. Once a choke point becomes politically risky, even the possibility of new fees, controls, delays, or restrictions can change the cost of moving goods. Risk itself becomes a price. The toll may be formal. The toll may be insurance. The toll may be delay. The toll may be a longer route. But the bill still enters the system. UN Trade and Development estimated that higher shipping costs could raise global consumer prices by 0.6% by 2025. For small island developing states, processed food prices were expected to rise by 1.3%. That detail matters, because the damage is not equal. Countries that depend heavily on imported food and maritime transport feel the shock harder. Same global disruption, different household pain. Fourth channel. Inflation and interest rates. If oil, food, freight, insurance, and defense costs rise together, central banks face a trap. Cut rates too fast, and inflation can return. Keep rates high, and mortgages, credit cards, car loans, business loans, and government debt stay expensive. There is no clean button. We already saw how painful rate resets can be after the inflation shock of 2021 to 2023. In July 2023, the U.S. Federal Reserve raised the federal funds target range to 5.25% to 5.50%. The Bank of England's bank rate moved from 0.10% in March 2020 to 5.25% by August 2023. For markets, those are policy rates. For households, they become monthly payments. mortgage payments, credit card costs, car finance, business loans, government debt interest. A war shock does not need to take your income directly. It can take your breathing room. Your payment stays monthly, but the number inside the payment changes. Here is the intellectual question. If your salary stays the same, but food, fuel, loan payments, taxes, and insurance all rise together, did your income really stay the same? That is why inflation is not just a price problem. It is a time problem. It steals future choices by making today's basics more expensive. Fifth channel, government debt. Wars are expensive because they compress time. Governments spend in years what they normally plan to spread over decades. They borrow faster. They issue more debt. They redirect budgets. Then they face the political bill later. SIPRI estimated that world military expenditure reached $2.718 trillion in 2024, up 9.4% in real terms from 2023. That was the steepest annual rise since at least 1988. $2.718 trillion is about $334 for every person on Earth. And that happened before the world was even in a formal global war. Now imagine the what-if scenario. What if defense spending jumps again, but healthcare needs do not fall? What if debt interest rises, but pension promises remain? What if infrastructure still needs repair, but security spending becomes non-negotiable? Every government budget has a hidden sentence inside it. Money used here cannot also be used there. So World War III could be paid for through higher borrowing, higher taxes, lower spending elsewhere, or inflation quietly eroding purchasing power. The bill would not vanish, it would change form. That is the part people underestimate. A government can borrow during the shock, but the economy still has to carry the debt later. That later can mean taxes, it can mean spending cuts, it can mean slower investment, it can mean higher debt service costs, or it can mean inflation doing the job quietly. The method changes, the cost remains. Sixth channel, markets and currencies. People often think war means stocks simply go down. That is too simple. Markets price cash flows, discount rates, supply chains, margins, and risk premiums. A company can sell the same number of products and still be worth less if borrowing costs rise, shipping costs rise, and customers slow down. That is not panic. That is repricing. The first payer is not always the final payer. A shipping company may pay the higher insurance premium first. An importer may pay the higher freight cost second. A retailer may absorb part of it third. A consumer may pay part of it fourth. A worker may feel it later if the company protects margins by freezing hiring. Same shock, different stop on the money chain. Currency is another layer. In global stress, investors often move toward currencies and assets they perceive as safer. That can punish countries that import food and fuel or borrow in dollars. They do not need to lose a port, they only need to lose purchasing power. A weaker currency can make imported fuel more expensive, imported food more expensive, dollar debt more expensive, and inflation harder to control. This is where World War III becomes bigger than the war itself, because global money is connected through trust. Trust in shipping routes, trust in banks, trust in payment systems, trust in currencies, trust in governments to repay debt, trust that tomorrow's invoice will still be payable. When trust falls, risk rises. When risk rises, prices change. And now the final twist. World War III would not hit everyone equally. Energy exporters and energy importers would not feel the same shock. Fixed-rate borrowers and refinancing borrowers would not feel the same pain. Countries with trusted currencies and countries dependent on dollar financing would not face the same pressure. Large companies with pricing power and small companies with thin margins would not absorb the same cost. Same war. Different balance sheets. So the better question is not, will everything collapse? That is too dramatic and not useful. The better question is, who absorbs the next layer of cost? Because in a global war, the money does not disappear. It moves through oil, food, shipping, insurance, banks, bonds, currencies, companies, governments, and household bills. Each channel adds friction. That friction is the real tax, not always voted on, not always announced, but paid anyway. World War II proved that the money layer can last longer than the fighting itself. The war ended in 1945, but debt, inflation, trade repair, and currency rebuilding kept shaping economies for decades. A modern global war would have different weapons and a different map. But the money logic would rhyme. War spending becomes borrowing. Choke points become inflation. Inflation becomes higher rates. Higher rates become expensive debt. Expensive debt becomes budget pressure. Budget pressure becomes taxes, cuts, or hidden inflation. And households meet the war through bills that look ordinary: petrol, groceries, mortgage payments, insurance renewals, pension balances, tax statements, job security. So here is the emotionally sharp question. If a war can change your future without entering your country, how much of your financial life is really local? If you have a genuine finance doubt about this topic, put it in the comments. Not a political argument, a money question. The best one may become a future video or a detailed reply, because this is the financial plumbing most headlines skip. Most people see war as a map. Money sees it as a network. And when the network gets scared, the price of almost everything begins to ask the same question: who pays next?